Well, welcome everybody. Welcome to Advancing Our Church, a podcast about Catholic stewardship, leadership, and advancement. I'm Jim Friend. Thanks for joining us today. We have a great conversation planned for you today with Mark Yusko, the CEO of Morgan Creek Capital. But before we get started, if you like our content, I hope you're going to stick around and subscribe. You can find us on YouTube or wherever you download your favorite podcast. You can follow us on Facebook, X, Instagram, LinkedIn. And for more information about our show, please visit us at advancingourchurch.com. And just a quick note before we begin our conversation today, because of the nature of the discussion, I just want to start with a little bit of a precursor to say that this is not financial advice, that the views that we express are simply an opinion and should not be construed as financial advice. Please seek the counsel of a qualified financial advisor who can look at your situation and help you make decisions. And please always be aware of your own risk tolerance. Mark, welcome to the show.
No, great to be with you and excited for the conversation.
So, Mark, I saw you at the Catholic Crypto Conference a couple years ago. I think it was the fall of 2022. And I followed you, of course, on social media and on many podcasts. And one of the things I was curious about is what led you into the Bitcoin space? What led you into cryptocurrency originally?
Such a long tail. And Jim, I don't do short well.
Okay, no worries.
No, but I'll try. I'll try.
Right. Sure.
It's funny. I used to say that my life was just this series of happy accidents.
Yeah.
And someone said, "No, Mark, it's divine intervention." I said, because there's a plan, right? And so I kind of like that. And I don't wear it on my sleeve all the time, but I on this show, I think clearly people will understand and appreciate that I do think there's a little bit of a whisper, and I'll throw a couple of these things. So look, I grew up on the left coast. My parents moved around a lot while I was in high school. I went to 3 high schools, hated my parents. I know I'm not supposed to hate, but I've forgiven them since. And,
thank God. That's good.
Yeah, no, I have forgiven them, but
sure.
But it was tough. 3 high schools, and I went from Seattle to Connecticut to Texas.
Whoa!
So you couldn't have 3 more disparate places. But then the first happy accident, and again, this one I really think was divine intervention. I ended up at Notre Dame, right behind me over there, on the wall, the Fighting Irish. And why did I end up there? So my parents were not college folks. My dad had gone to Bryant College when it was a 2-year college, and he was a foreman at AMF, and he hated it. And so he packed up the family and moved across country to Seattle and went back to school at 29 and then got a real degree and came out and went into consulting and had a nice career. But they didn't tell me what to do when I was thinking about college, but I had a guidance counselor, and I could not make this up. Her name was Faith Diamond.
Wow. Okay.
I could not make that up. I just can't, right? And she gave me a list of 10 schools, and I went down unceremoniously and said, Harvard and Yale, not going there. Carnegie Mellon, never heard of it, not going there. Emory, don't know where it is, not going there. Notre Dame, heard of it. UVA, heard of it. WashU in St. Louis, I actually thought was University of Washington, where I grew up. That's how uneducated I was. And my dad took me on a trip to Notre Dame, and I walked on the campus in the middle of a snowstorm, no students, and we're having breakfast. And again, I couldn't make this up. It's so crazy. So snowing, there are no students. It's just my dad and I in the Morrison. And I look outside, and a cardinal alights on the tree branch. I'm like, okay, that's a sign. And now through a bunch of other things, I ended up at Notre Dame and loved it. And the thing that really has stayed with me, and while I've been involved at Notre Dame with my wife, met her there, and both our older kids went there, and we have a little guy who probably will go there. But it's always stuck with me that all of the top 20 universities were formed by religious organizations. Only one remains where they believe that faith and reason can coexist, and that's Notre Dame. And so that's kind of always stuck with me. And all right, so you asked me, how I got into Bitcoin. That has nothing to do with that, but it does, in the sense that I actually went to college And, you and I I'm older than you, but, the Brady Bunch, the television show that you probably remember.
Sure.
I wanted to be Mr. Brady. I thought he had the greatest job in the world. He made little models. He was an architect. And so that's what I went to Notre Dame for, one of the best architecture schools. And the third year, the architects go to Rome, which I thought was pretty cool. But I lasted one semester. It just wasn't for me. And the real reason is, first project, stay up 2 weeks straight, all night, working on this project, and you put it up, and you go in the room, and they're all tacked on the board, and the professor comes in, he looks at mine and says, just misses, B-. Like, what do you mean just misses? It's perfect. What's wrong with it? I don't know, just misses. That's when I learned I was not a subjective person. I'm objective. I need rules. I need feedback. And so bagged architecture. Dad wanted me to be engineer and become a consultant like him. So I did that. Didn't like it. And I was dating a girl, and she said, well, why don't you do what you like? I'm like, well, there's a novel concept, because I'm a dutiful firstborn. If Dad says be a consultant, that's what I'm going to do.
Sure.
But do what you like. So what do I like? Well, I like science. So studied pre-med, but I couldn't answer the question, why do you want to be a doctor? So didn't go to med school. And the funny part is, so when you're 1985, graduating from college, degree in pre-med, and you're not going to med school, there are two jobs: healthcare consulting, which Dad helped me get, or pharmaceutical sales rep. I am not 6'4" and handsome, so that was out. And so going to be a healthcare consultant. But the partner who I was going to work for said, you've taken no business classes. Why don't you go get a business degree? And I'm like, can you still do that? Right. And again, I can't make this up. So going to put my applications in for business school, Stanford and, Harvard and Northwestern and Chicago. And I'm putting the Chicago letter in, and a cardinal alights on the mailbox right across from the Morrison, probably the same cardinal for all I know.
Wow.
And so I ended up in Chicago, and my wife was a year behind me. So we ended up together and got married. And so I take the first job that's offered, and the guy who was doing investments retired. That's it. That's how I got into investing. Again, just divine intervention. And then went to work from there from the insurance company to an asset manager. Then I got the calling. And, some people know the story of Notre Dame football coach, Lou Holtz. He had a lifetime contract at Minnesota, unless Notre Dame called. And I kind of had the same thing. I worked for this firm in Chicago. We had $1 billion back when $1 billion was a lot of money. And there were 5 of us. I worked for 2 professors at Northwestern. And they kept most of the money, but someday the young guys would make some. But I got a call from Notre Dame, and I just really wanted to go back to the alma mater. So I went back, and I didn't know anything about endowment management. But once I got there, I learned that endowment management was really everything. That asset allocation is what drives the big returns. So I told you I don't do short well, but I'll get to the answer.
It's all good.
So I got there in 1994, and in 1995, we had this really good board member from Boston who said, the best endowments, Yale, Harvard, Stanford, they're beating us. Well, why are they beating us? Well, they have more money in venture capital. So go find out what they're doing. So we went out to California, hung out with the Stanford guys, and we met, which are today legendary firms. Back then, no one had ever heard of Sequoia, Kleiner Perkins, Caulfield Byers, when it was still called Kleiner Perkins, Caulfield Byers. I always feel sorry for Caulfield, Perkins, and Byers because no one talks about them anymore. They just call it Kleiner. And we invested in Sequoia, for example. We gave them $5 million, and they put 10% of it with this company called Google. And I actually remember the board meeting where we're telling the board about this, and they're like, that's a stupid name. Well, now it's a verb, right? We all use it every single day. And they said, well, what do we need the 21st search engine for? There's Ask Jeeves, there's Web Crawler, there's Alta Vista. But what they didn't understand, what I didn't understand at the time, was it wasn't a search engine. It was an entirely new way of accessing information on this new thing called the internet. And so we put $500,000 into this little company called Google, and we took out $200 million, right?
Wow.
There should be a quad at Notre Dame called the Google Quad. And so I had this aha moment. I mean, literally the Eureka moment that, wait. Investing in innovation, right? New ideas, things that make you really uncomfortable. Like I say this all the time. If you make an investment and you feel good about it, you're probably going to lose money. If you feel really good about it, like you are sure, you're probably going to lose a lot of money. When you make an investment and you feel a little uncomfortable, you're probably going to make money. If you feel really sick to your stomach, you're going to make a lot of money. Like when I came down to North Carolina, the first investment I wanted to make was in oil, 1998. And the price of oil was $10. If you remember, The Economist magazine had a picture of the guys covered in oil, and they said oil was going to $5. They said someday it might even be free. I'm like, I don't think so. No. So I have this rule. If I hear it once, I remember it. Hear it twice, write it down. Hear it 3 times, do something about it. So I remembered that. 2 weeks later, Richard Rainwater on the cover of Business Week saying he's naked long, not naked like naked, but naked long, meaning only long $900 million of oil, which again, back then was a lot of money. And I tore that baby out, put it on the desk, wrote that down. 3 weeks later, 3 guys trained by Richard came to our office in Chapel Hill and said, hey, we're raising a fund to invest in oil. And I'm like, ding, 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 got to do it. So I go to the board meeting, and I'm brand new at Chapel Hill. I'd left Notre Dame to come down to Chapel Hill. And so I go in and I said, I want to take 1% and give it to these guys and 5% and put it in commodities, primarily oil. And my board chair, Mark, that's the dumbest idea I've ever heard. But if you really want to do it, okay. And I'm like, okay, great. And so he calls me into the chancellor's office, the president's office after the meeting. He says, Mark, when I say that's the dumbest idea I've ever heard, that's what I meant. That other stuff was just to be nice in front of all the guys. You're brand new. And the chancellor says, well, Max, if we're not going to take his ideas, we should probably just fire him right now. But since he's only been here a couple of weeks, maybe we should try a couple ideas. And if they don't work out, then we fire him. I'm like, hey, I'm sitting right here. Now, the funny part of that, and this is not because I'm smart, it's because Richard Rainwater's smart and these guys trained by Richard were smart. That 5% that we put in oil generated 25% of the endowment's returns the next decade. So what does this all have to do with crypto? So I have these experiences that things that make you uncomfortable are really important. The other experience was I thought about my life up to that point of that aha moment in South Bend. So I grew up, my dad, after he got his college degree, he became a consultant and he installed computers in hospitals. Imagine computers not being in hospitals, right? That was his job. He took them from IBM, he installed them into hospitals because they didn't have them. And so it's like, well, okay, if you go back to 1954 when they invented the mainframe, then there was 14 years later, there's innovation around this thing called the microchip. And this guy, Don Valentine, who started Sequoia, invested in this little company called Intel, which most people have heard of.
Of course.
And then 14 years later, I grew up in Seattle. There's this little innovation around the personal computer. Now, interestingly, the guy in Boston who started DEC, Digital Equipment Corp, said that no one would ever want a computer in their house. And in fact, Steve Ballmer's mom said, Steve, why would you work for this company? No one would ever want a computer in their house. I always joke, Steve has 18 billion reasons he was right, mom was wrong, and the guy at DEC was wrong. People did want a computer in their house. 14 years later, I'm sitting in South Bend making that investment in Google, and the internet was a thing. And Paul Krugman said, it'll never be more important than a fax machine. Now, why is it always 14 years? Because young people invent everything new. So the young people have a good idea and they go with it because they don't know that it won't work. And so Mark Andreessen was 19 when he created the browser that you and I are using right now. And TCP/IP was created and voice over internet protocol. So 14 years later, it's 2010. And I remember being back in Seattle. Craig McCaw, famous investor in early cellular, his family office had an event, and I was talking to his family office guy. I said, do you think the mobile net is going to be as big as the internet? He's like, Mark, you joking? Ask people on a computer, like whatever. Ask them if they want a phone. Like, I already have two. I probably don't need another one. Yeah, the mobile net's going to be bigger than the internet. And the internet created 2 trillion, with a T, of value.
Right.
The mobile net created 5 trillion of value. Huge. So now, 14 years later, which is right now, 2024, we have this thing called the truth net. Now, what is the truth net? So now I'm going to answer your question. So it's a long prelim, but here I'll answer your question. So 10 years ago, we had made a couple investments in this emerging thing called blockchain. Now, what is blockchain? Well, blockchain is, as the name implies, it's a chain of blocks of information. Well, why does that matter? Well, what a blockchain does, it establishes truth instead of trust. And what does that mean? Well, let's think about this just old school. Back in the olden days, I would lend you money. And I would write down on my papyrus tablet, because I'm a super old guy, that you owe me $100, right? You come back a year later to pay me $110. And if I happen to be unscrupulous, I just change the number to 200 and say, hey, Jim, you owe me 200. You're like, but I only borrowed 100. I'm like, it says right here in the ledger, because there were no 2 ledgers. So 838 years ago, the Medicis stole a little idea from the Portuguese monks, literally the Knights Templar, and said, hey, let's have 2 ledgers. Jim, you keep a ledger. Mark, you keep a ledger. And we, the benevolent Medicis, for a small fee, will establish trust, right? Mark, you write down 100. Jim, you write down 100. Jim, you come back. Now, the problem is I'm a bad guy. So I go to the Medicis during the year. I say, you know, guys, I'm going to change my number to 200. I'm going to give you half if you go along. So you come back to pay the 100. I say, no, it says 200. And you say, hey, Medicis, Jim, you must have written the number down wrong. And so the system was corruptible because we didn't have truth. We had to rely on trust. In fact, I use a simpler example. I have this recurring nightmare, not like every night, but maybe once a year. You go to the ATM, you punch in your code, and it says 0. How would I prove it's not 0? I don't have a statement. I haven't had a statement in years. It's their word against mine. They're the big, powerful company, and they could manipulate the data to say, hey, Mark, you got 0. But trust works most of the time because mostly people are good people. But occasionally, bad people do bad things, and we have a breakdown. Well, what blockchains do is they create a third ledger. So now I lend you 100. My ledger says 100. Your ledger says 100. And thousands of computers around the world say, yep, it was 100. I can't change it. You can't change it. We have truth. And truth is better than trust. And so, and to bring it all back to the church, when I really, really got excited about this, if you go back thousands of years, the church had a monopoly on how we think, right? You'd go to church on Sunday and you'd be told what to think, how to think, when to think, because most people didn't read or write, and they came communally to have the elders or the people with authority give them news or information, right? The printing press busted that monopoly wide open because now we could distribute information. We could teach people to read and write. And so governments took that monopoly through media, either state-owned or state-sponsored media. Well, then the internet busted that monopoly wide open. Think about in the olden days, if you wanted to know about the Argentinian election, you would wait for someone in New York to send a reporter to BA, write a story, go back and forth, edit it, and then on page 17 of the New York Times, maybe you'd find the results. Today, I can go to Twitter and watch a periscope of live footage of people standing in line chanting Milei's name. Like, yep, that guy's going to win. That's far superior. And the internet busted the monopoly. And so the media companies and the commerce companies, all that market cap that was concentrated ended up in these innovative businesses. What blockchain does is it busts the monopoly that the Medicis created 838 years ago. the banking industry has had a monopoly, and they extract $7 trillion a year. Big number. 7 trillion in fees for having accounts and for transactions. Like today, if I want to send you money, right, across state lines, you'd have to have a bank account, I'd have to have a bank account, and they'd charge me a wire fee. Well, with blockchain, I can punch a couple buttons on my keyboard and send you money. And here's the other part of it, and this is the piece that really got me excited about Bitcoin in particular, is there's only one money in the history of the world, really. I mean, there have been multiple attempts, but only one that survived for the last 5,000 years, and that's gold.
Right.
Well, what do I mean by that? Well, money is an asset that exists in the absence of a liability. Everything else that we think of as money are actually currencies. They're backed by debt, government debt. And so dollars, yen, euros, drachma, whatever, drachma went away, now we have the euro. Those are currencies. But gold has been money for a very long time, right? Back to Cleopatra's time, to a suit of armor, to a zoot suit in the 20s, to Savile Row today. You take a single ounce and you get exchange for a fine person suit, because it's been a perfect store of value. And the currencies, the paper currencies, there have been 775 paper currencies in the history of the world, starting in the 1300s in China. 3/4 of them disappeared. They just vanished because governments get so far indebted that the empire eventually crumbles. Roman Empire, Ottoman Empire, British Empire. Now, Britain's still there, the UK's still there, but a single pound note 360 years ago would get you a pound of sterling silver. Today, it would take you 174 pounds of sterling silver to get a pound note. So it's that dilution of value that's preserved in true money. But here's the problem with gold. Let's say I had a bar handy. Now, if I was Kyle Bass, right, everybody knows Kyle, he would literally reach under his desk and he would pull out, he keeps a 26 kilogram Australian gold coin in a safe under his desk. If I had that and I wanted to break it in half and send you half, I'm not strong enough to break it. It's not very divisible. Even if I could break it, I couldn't stuff it in the computer and send it to you. So it's not very functional. Whereas Bitcoin, it has the same scarcity as gold, meaning the amount of new Bitcoin each year that's created is roughly equal to the amount that's lost or stolen, same with gold. So the scarcity is the same, and that's why scarce assets retain their value, but the divisibility and the portability are better. So I think for the next 5,000 years, Bitcoin becomes. So that's a super, super, super long answer to why do I care about digital assets? Why am I a late in life venture capital? I say my chapter 1, I work for not-for-profits. Then at my chapter 2, I built a nice little asset management business. And then for the last 5 years, my chapter 3 is I have been a venture capitalist investing in the digital asset ecosystem. And then chapter 4, I'll teach.
Yeah. Well, that was tremendous. That was tremendous, Mark. Comparing Bitcoin to gold, I've heard some say, though, that Bitcoin is actually more scarce than gold, because sometimes if you just dig a little deeper, you're going to find a little bit more gold, and they're finding new veins of gold all the time. And doesn't that devalue the price of gold over time? But we know there will never be more than 21 million Bitcoin. And we also know that probably a couple million or so have already been lost. So,
right. No, it's a very good point. And, and we did cross that Rubicon
right
a couple years ago. And
sure.
And so if you think about scarcity, scarcity makes things valuable.
Exactly.
I always tell this funny, it's a funny story. So Nicholas Sparks, everybody knows Nicholas Sparks,
right?
The Notre Dame guy, a writer, wrote a couple good books. And he commissioned this artist to make him, and what he does, he takes a photo and then he paints over it, and it's these trees. But he had him he commissioned one, and he called it One.
Yeah.
O-N-E. He said, can never make another one of these. It has to be one of one. And he said, I'll pay you $1 million for it. And On the day that he bought it, it was worth way more than that because there's only one. It's the most scarce of that thing there is. Yeah. And in my youngest son, he's 13. So we have 2 older kids and then our caboose. And great blessing. I mean, amazing. We're much better parents the second time. Not that we were bad parents the first time. We just didn't know.
I get it. Yeah, sure.
We
you made all your mistakes.
Now we know stuff.
Sure.
But so he got me playing Magic the Gathering. And I don't know if you've seen the video, but Magic the Gathering put out this new line of cards around Lord of the Rings. And they made a 1-of-1 ring card. And this guy opened the pack and got it. And he happened to be videoing. And his hand was like shaking because he opened a 25 million. Now, is that really worth 25 million?
Right.
Arguably not. It's a piece of cardboard. But because there's only one, and there are a lot of people in the world that play Magic the Gathering that would pay him a lot of money to have that 1-of-1. So scarcity creates value.
Yeah.
And it's because there's certainty, right? One of the problems with our money, right, the dollar, is this thing called the Federal Reserve, which I always joke is neither federal nor has any reserves.
Nor reserve, right?
It's actually not a bank the way we think of a bank. It's actually a private corporation owned mostly by Europeans, which is kind of weird. So wealthy European families. And it was created in 1913, modeled after the Bank of England, which was modeled after the Dutch National Bank. It was created by a bunch of European families back in the 1600s. And what a central bank can do is they can create money out of thin air. Well, wait a second. Isn't that bad? Like, think about it. If I have a stack of $1 billion over here, and I create a new stack of freshly minted $1 billion, what just happened to the value of my old stack? Well, it got cut in half. So it's a really interesting phenomenon. From 1776, when we created the Republic, to 1913, a dollar, which is borrowed from the Dutch, right, the Rijksdollar, so because they had the first central bank. So the dollar was worth $1. Now it had a little fluctuation around a depression and a war, civil war, but $1 is worth $1. There was no such thing as inflation. In 1913, the Fed was created by these wealthy families, J.P. Morgan, John D. Rockefeller, the guys from the Rothschild clan from London. And they created this with the sole purpose of controlling money. Because Baron Rothschild years ago said, I care not who issues the laws. If I issue the money, I am the law, or something similar to that. And if Thomas Jefferson said it best, right? If you ever let a private enterprise control the issue of money, your grandchildren will wake up penniless on the shores of the land that their grandfathers conquered. And it's true because if you can create something with no effort, at least with gold, you have to mine it. You have to find it. You have to dig for it. You have to mine it. You have to smelt it. Right. With Bitcoin, you have to do something called proof of work, right? You have to buy a machine and you have to tap into the algorithm and you have to pay for electricity and you have to produce effort. And this is one of the most genius things. If you think about all of life, big statement, right? All of life.
Right.
It's about converting energy to value, right? You create a podcast, you fuel your body, right? You fuel your mind, and then you produce value through your effort. If we're supporting our church, right? We're giving our time, our talent, our treasure, okay? We're converting energy to value. Mm-hmm. And everything in life is about that. And so things that go against that are antithetical to true value creation. So I always use the example of, actually the best performing asset in the last decade isn't Bitcoin. I mean, Bitcoin's been great. It's better than stocks, better than bonds, better than gold. But the best performing asset is another scarce asset, collectible Porsches.
Really?
Yeah. And the reason is they call it the dentist wrap phenomenon, right? Said dentist, and I shouldn't pick on dentists, but that's what they call it, buys the Porsche, and no one tells them that you should never accelerate when the wheel is turned. There should actually be a string on the bottom of the steering wheel. If you're going straight, hit the gas. If you're going sideways, you can't hit the gas.
Don't hit that gas.
But
yeah.
they turn the wheel, they hit the gas, wrap it around a tree, end of Porsche. So as those Porsches get crashed, the few that survive become collectible. And there are three guys, Jay Leno, Jerry Seinfeld, and John Shirley, the number 3 guy at Microsoft, who will pay whatever it takes to get those collectible rare cars. And so the price of rare Porsches has appreciated more than anything because they're scarce. And we can think of lots of examples in our lives. Someone's time is scarce. I mean, not to go too far in a downer, but I literally learned this morning that a good friend's tragically lost his father-in-law in a car accident. I mean, just life is precious and time is scarce. And so time is scarce. Relationships are scarce. Talent is scarce. There are few people who have real talent to do certain things. Leadership skills. One of the reasons we have a big commitment at Notre Dame to training the leaders of tomorrow is, I think leadership is a very valuable asset. So we try to, identify young leaders and help them with scholarships. So that idea of scarcity is really important. And particularly when we're talking about money and investing. And, look, I mean, you're the title of your podcast, right? Advancing our church. How do we advance anything? Mm-hmm. Time, talent, and treasure, right? It's
Absolutely.
The concentration of that conversion of energy into value.
Absolutely. So, Mark, let's talk a little bit about the ETFs, if we could, and because they've really opened an on-ramp for institutional buyers, and we've seen a lot of that, especially in the last couple of months. There may be folks who are in charge of Catholic foundations or their Catholic organization may be thinking, "Is this the right time to invest?" What are your thoughts on that?
So the answer is yes, and my big thing. So what was it? 2013. So 11 years ago, our PR firm said, "All right, Mark, you got to get on Twitter." I'm like, what do I need to post pictures of my food for? I mean, that's all Twitter was really used for back then.
Right.
Now, everyone I know, I've met through Twitter. I have friends all around the world. I mean, literally this friend I was just talking about, he's in Tokyo. He's now, visiting family in Bangkok. And I mean, I love the community that is Twitter. But 11 years ago, I didn't really understand it. And so he said, you got to get on Twitter. I'm like, okay. Why? Well, because you need to, communicate with your investors, and you need to get involved in the community and educate. And so I created the series of hashtags, right? And one of my hashtags over the past 7-8 years has been Get Off Zero. Okay. Now, what does that mean? It means that zero allocation to Bitcoin and digital assets is the wrong number. And I've been saying for a while that, look, when I started down this path in 2013, 14, I didn't really understand it. It's a true story. I got introduced to Bitcoin the same month as the Winklevoss twins. And if you've read the book, Bitcoin Billionaires, which is a great book, Ben Mesrick is a brilliant writer. It's an easy read. You could read it over the weekend. So good. Such a great story. But they're multi-billionaires and I'm not. Why? Well, they got it. They were younger. They didn't have a business that they were tethered to. When I got introduced to it by this good friend of mine, I got the idea, but then when I started doing work and I started writing about it to my clients were like, "No, you're an idiot. Go back and do your job. We'll fire you if you talk about magic internet money." And the price went from $500 to $186. This was from March of 2014 to September. I'm like, they were right. 8 weeks later, it was $1,000. I'm like, no, there's something here. What is it? Why does it keep being so resilient? It would go down, it would come back up, and then it would go down. And every time it was making higher highs and higher lows, and the value of the network was growing. So I started diving deeper into this idea of network effects. And there's this guy named Sarnoff, and he created something called Sarnoffs Law. So when I was growing up in Seattle, I could listen to WGN radio, which is in Chicago, right? Well, how is that possible? Almost 3,000 miles away. How is that possible? Well, they had this giant antenna, and it would beam this magic signal, and it would bounce across the atmosphere, and I could hear it. Well, Sarnoff came up with this rule that said that networks, were equal. The value of a network was equal to the number of people that could hear that signal. So he said it was a linear relationship. If you heard it and I heard it, then it went up 2, and if another person, it was 3, and then 4. Well, then this guy Metcalf came along at MIT and said, well, yeah, okay, that's fine. But what if Jim and Mark talk to each other? What if they form a connection? Well, now it's not a linear relationship. Now it's an exponential relationship. And the difference between linear and exponential, the most powerful example I use is if I take 20 linear steps across the office, I get to the other side. If I take 20 exponential steps, I go around the world twice. It's unbelievable, right?
Interesting.
And so exponential growth of networks was the really big thing. And if you think about the 5 biggest, most valuable companies in the world, they're not companies the way we think about companies. They're networks, like Amazon. What does Amazon make? They don't make anything. They connect buyers and sellers. They take 46% take rate, which is a really big deal because it's a very powerful network. And so those networks became super, super valuable, like the Apple network. It's not one phone is not very valuable. Lots of phones together, very valuable. So I did the work and I was all in. And my son was graduating from Notre Dame. And everyone's seen the movie The Graduate, right? One word, plastics. I didn't say plastic. I said one word, blockchain. So I want you to go out to California and go to work at Coinbase. And he said, I don't know, Dad, maybe it's going to be a big deal. I'm just going to go to KPMG. It's safe, gets me to San Francisco. I've always wanted to live in San Francisco, get in tech. I said, you're going to hate it. And he did. 9 months later, he quit with no job, which is a millennial thing. And now the end of that story is great. He did get another job, and then that company got taken over, and then he went to another one. They went public, and they did really well. It's called Snowflake. But when Coinbase went public, he did call me, and I'm really proud of him. He called me and said, all right, Dad, you were right, but you're not as smart as you think you are. I'm like, oh, do tell. I told you to work at Coinbase. He says, yeah, but you didn't lever up the house and put all in Bitcoin. I'm like, you are absolutely correct. Why? Why didn't I? Because I was still a little bit skeptical. But by 2016, I had done the work and I had that aha moment. And I actually wrote about it in something called Digital Gold Rush. I was actually in Eureka, California. Couldn't make that up. Behind the wheel of an RV with my family. And it hit me that in the gold rush, it wasn't the gold miners that made all the money, right? It was the picks and shovels guys. It was Sam Brannan, who owned the general store, who sold them the picks and shovels and pots and pans. And so we built our firm, Morgan Creek Digital, to invest in the infrastructure, the picks and shovels, companies like Coinbase and others that provide the infrastructure. And so to get to your point on the ETFs, so zero exposure to this technology, this innovation was wrong. Well, why was it wrong? Look, I've been around a super long time, just, lucky, fortunate. And I've seen every attempt at diversification. Like when I started in the business, I am this old, it was frowned upon for fiduciaries to own stocks, right? Remember the cover story in 1979, death of equities, no self-respecting fiduciary should ever own equities again because the market had been dead money for a decade from 68 to 79. People were fed up and they're like, just own bonds. And then ERISA came along and said, no, you really need to own stocks. And then you got to own international stocks. And then you got to own hedge funds and private equity. And this all came to Markowitz, who I fortunately got to study under at Chicago, great blessing. And Dr. Markowitz won the Nobel Prize for saying, when you take cash, the riskiest asset you could ever own, he said, no, it's the safest. Oh, no. It's the safest in that you don't lose anything. But every day, the Fed is stealing a little bit of your wealth through inflation, so you're getting less rich. So if you start with cash and you add bonds, which bonds can default, they have risk, that portfolio is actually less risky. When you add stocks, risk goes down. When you add international equities, risk goes down because they're uncorrelated to one another. But here's the problem. All these uncorrelated assets that follow Markowitz diversification, they're kind of uncorrelated. Stocks and bonds are 30% correlated, international stocks 60% correlated, small cap stocks 80% correlated, value and growth 85% correlated, hedge funds 70% correlated. So yes, they do lower, like if I had real estate or hedge funds or private equity, I do lower the risk, and Yale, Princeton, Stanford, Harvard have mastered this. Same with Notre Dame. But here's the thing. Bitcoin is not only the best performing asset over the last 15 years, it's also the lowest correlated asset. It has 0.0 correlation to bonds. What does that mean? All that means is that if bonds go up, you don't know what Bitcoin's going to do. If bonds go down, you don't know what Bitcoin's going to do. They're totally uncorrelated. Doesn't mean negatively correlated. It doesn't mean one zigs when the other zags. It just means there's no information content in what bonds are going to do and Bitcoin's going to do. And Bitcoin is 0.15 correlated to stocks. So when you add it to a portfolio, the return per unit of risk, the return per unit of volatility, the Sharpe ratio, goes up more than anything else. So if you had just taken 1% a decade ago, right, and put it into Bitcoin, your portfolio, instead of compounding at 9, would have compounded at 11 with less risk. Well, what if I'd taken 2%? Then you would have compounded at 3% higher. What if I put 5%? You would have compounded at almost 10% higher. Now, this is not promissory. That's not saying this is going to happen in the future. But what it says is that we have this asset. And the reason it's uncorrelated is because stocks, bonds, etc., all rely on the same thing. They rely on interest rates, GDP growth, demographics, inflation. Okay. Bitcoin doesn't rely on any of that. Bitcoin is all about the digital divide. I tell this time, ask anyone over 35, who's your broker? Oh, I don't know, UBS, Merrill Lynch. Why? How much gold do you have? I don't know, 3-4%. How much Bitcoin do you have? Oh my gosh, 0. Are you kidding me? It's a Ponzi scheme. Haven't you heard that Peter Schiff guy? How often do you use DeFi? What the heck is DeFi? What are you talking about? Okay, ask anyone under 35, and DeFi stands for decentralized finance.
Right.
So ask anyone under 35, who's your broker? What's a broker? I mean, I have a Robinhood account. Okay, how much gold do you have? Whoa, are you kidding me? Boomer rocks? 0. Haven't you heard that Peter Schiff guy? How much Bitcoin do you have? I don't want to talk about it. Why not? Because it's like a really big percentage of my net worth. I'm kind of embarrassed. How often use DeFi? Every day. So that digital divide is real. And I say this all the time. I do have the prop. So I have 3 grandkids, and 1, 3, and 5. And my 1-year-old granddaughter is a Zoomer, right? She's a Gen A. She will never have one of these. She will never have a leather wallet. She will never use paper money. She'll probably never drive either. But she'll never know what paper money is. She'll never know why you would have a wallet. She'll have a digital wallet, and she'll have digital currency. And the easiest example is, imagine in the future, and probably not that distant future, you're in the back of the car, and the car's driving you, and it pulls into the fast charging station. It won't take 45 minutes. It'll take 4.5 minutes. You won't get out of the car and put a plastic card into some machine. The car will pay the machine. It'll pull away. You'll get on the freeway. You say, you know what? I want to go in the fast lane. So you pull in the fast lane. It won't take a picture of your license plate and send you a bill for $4. The car will pay the machine. Okay. And so these microtransactions will happen in real time over blockchains, and we'll have a digital currency, most likely Bitcoin, because ultimately all Bitcoin is a ledger, right? It's not little tokens. It's not little gold things. It's a ledger.
Right.
And a ledger that is secured by the most powerful computing network that the world has ever seen. Right? It's been up for 15 years. It's been down for 20 minutes in 15 years. It's never made a mistake. Here's a crazy thought. How many times people listening to this had to get a new Visa number, MasterCard number? Plenty. Why? Well, I'll tell you why. Because Visa and MasterCard today run on a mainframe computer. Not even a microcomputer or a personal. They run on a mainframe computer coded in COBOL.
Ooh.
Okay. Now,
That's a word you haven't heard in a while. Yeah.
Why? Well, to change it would cost a lot of money. Yeah. And they say it's actually kind of a moat because no one knows how to hack it. The problem is a few people still do. And so they do get hacked. And that's why you have to get a new number. He says the only problem is when it breaks, we got to put a light on at the Sunnyvale retirement home and some 80-year-old has to come over and fix it because the only people who can code COBOL are 80, which my dad's 86 and could code COBOL, so he would agree with that. So ultimately, again, this is a long-winded way of saying Bitcoin is here to stay. Blockchains are here to stay. They're as inevitable as the internet. Now, in 1998, the internet was about 11% penetrated. And most people were like, no, this is ridiculous. Again, Krugman said it'll never be more important than the fax machine. And people didn't invest early in Intel and Cisco and Microsoft because they didn't understand or believe in the internet. Remember the cover story in 2000 of pets.com? The sock puppet was run over. Well, here's the thing. Chewy.com, it's the same company 20 years later, worth $7 billion. Now, it did take 20 years. Well, why did it take 20 years? Well, because the idea was really good, but you needed GPS tracking. You needed better logistics. You needed people to have broadband in their house. You needed to be able to have video conferencing. And you needed people to trust that they would put their credit card and not have it lost because it would be encrypted. So all of these technologies build on each other. And we get this exponential growth rate, just like Sarnoff and Metcalf. We get Web 1, Web 2, Web 3. So Web 1, 2 trillion, Web 2, 5 trillion, Web 3, which I've been shilling this great book called Read, Write, Own by Chris Dixon. And it talks about Web 1 was about read, right? Websites that you could read. Couldn't interact, couldn't do anything. Web 2, big companies came out and said, you know what, you can post your pictures to our website, then we'll get paid for them, which is kind of crazy. And people, I don't know if you've seen this new movie. This kid, high school kid, made a movie. It's a 12-minute mini movie. And he posted it on the internet. It took him 2 years. He got an email from somebody out in California saying, can you drop out of Harvard? Because we will make you a director right now. It's wow. That good. I mean, it's called like Anything But Everything or something like that. I can't remember the exact name of it, but it is spectacular. But he put it up there for free. Okay. So we could all enjoy it. It's been viewed 4.7 million times. And YouTube makes a lot of money by selling access to their product. So that's the read write. But now how about the fact that if I want to post my pictures and people want to look at them, I get paid? Or how about whatever cookies I create on my online traffic, how about the advertisers pay me? Or if I want to write a song, instead of going through the typical channels to get it distributed, how about I distribute it to the web, to my audience directly, and I get paid? So read, write, own, Web 3 allows ownership. And that ownership is driven by the blockchains, right? The networks, and then the tokenomics, right? The tokens or the entries on the ledger that say who owns what. So very exciting.
Excellent. Mark, what would you say to anybody who's concerned about some of the price volatility? Right now, we're in a little bit of a dip below 60, and you hear that a lot. How do you feel about
volatility is your friend. I have a shirt and it says embrace volatility because again, this goes back to Markowitz theory. And again, he won the Nobel Prize. It's not me making this up. What you want is a collection of the highest volatility assets that are uncorrelated. Like if you want to minimize your volatility, put it all in cash, which is the dumbest thing you could ever do because You'll wake up with less wealth because inflation will steal it all away. So you can buy something that's a little more volatile, bonds, and maybe you can keep up with inflation. You can buy a little more volatile stocks. But here's the myth about volatility. Volatility is not risk. Volatility is simply disagreement about the future prospects of a business. So I'll give you an example. Amazon.com and Bitcoin have the exact same volatility, 80. This is amazing.
Wow.
Amazon's been a public company for 27 years. In every single year of those 27 years, they've had a double-digit drawdown, including this year. Okay. On average, 31%. Meaning, on average, you lose a third of your money every year, in theory. But when was the right time to sell? In fact, twice you lost more than 90%. But when was the right time to sell? Well, never. Well, who bought Amazon.com on the IPO and held it to today? There's only 5 people. Jeff, mom, dad, ex-wife, Bill Miller. Bill Miller's cost is 7 cents. Right? It's 100. Actually, no, it's less than that. It's 0.7 cents because just did a 10 for 1 split. So 0.7 cents, and it's worth $177. So he was the only one that got that volatility didn't matter. What matters is the long-term accumulation of the network value. Same thing with Bitcoin. Bitcoin is the best performing asset over 1, 2, 3, not 3, 1, 2, 4, 5, 10, 15 years. 3-year number is not very good, because there's been volatility. But that volatility corrects itself over a long enough time horizon. There's no 4-year period in which the return on Bitcoin is negative, none in 15 years. And that volatility is a feature, not a bug, because it's uncorrelated with the other things in your portfolio. So the thing about it, I was on CNBC back in, I think it was 2018. And the price, while it was on the show, went from about 10,000 to 8,000, right? So it dropped a lot, like in the 6 minutes, which I wasn't even on the show for very long, but in the 6 minutes. And Melissa Lee looks at me at the end and says, "So what should we do?" I'm like, "Well, buy it." She says, "What? You'd always say, you'd say if it went to 5,000. I was like, "Yeah, buy it today, buy it tomorrow, buy it next week, buy it next, don't buy it all at once. Buy some today." What Bitcoin is, it's the perfect savings technology. It's deflationary money instead of inflationary. So whereas every dollar I get paid for doing my job, converting energy to value, the government slowly steals it back from me. Over a 30-year period at 2%, they take half my purchasing power over a 30-year period. That's crazy. Okay. With Bitcoin, every dollar I save in Bitcoin over the 15 years has gone up in value, but it actually hasn't. This is the genius of it. one Bitcoin is 1 Bitcoin, but we don't price Bitcoin in Bitcoin. We price Bitcoin in dollars, right? So the dollar has been getting less good. Think about what you paid for, when I used to go, I thought about this yesterday. I went to lunch, Chapel Hill, North Carolina, $20. My first job in Seattle, Washington, $5 lunch. So between, the last 30 plus years, lunch has gone from $5 to $20. It's the same lunch.
Ask anybody who's gone to McDonald's and tried to feed their family of 4. What does it cost now?
Somebody said a Chipotle bowl in California is like $39 now. Crazy. Whoa. Yeah. So the reality is, it's not that the food got better. It's that the money got worse.
Yeah.
When I was growing up in Seattle, a gallon of gas when I got my license was 33 cents. I was just visiting my son in San Francisco, $6.33 for a gallon of gas. It's the same gallon of gas. It does the same thing in the car. It's actually less good today because of ethanol in it, but let's just say it's the same. The gas didn't get better. The money got worse.
Yeah.
Here in Chapel Hill, where I live, according to Zillow, my house went up 50% in value in the last 2 years. No, it didn't. My house did not grow. It did not get more efficient. It actually wore out, and I had to put some money into it to fix it. So the money gets worse. And so here's something that most people don't think about. Everybody's all, stocks are all-time highs, right? Only if we price in dollars. Today, U.S. equities, the S&P 500, priced in gold, is the same price as 1996. Because the money is getting less valuable, and the things that store value, gold and now Bitcoin, are holding their value.
Is there a place where the economy runs out of track because we're scoring roughly what, about $1 trillion in new debt every 90 days or something crazy like that? Or
Look, it's a long conversation, but the way to
yeah,
think about it is every empire in the history of mankind has ended the same way, through excessive debt and borrowing and a currency collapse, right? The Roman Empire eventually, what happened with the Roman Empire is, they got super powerful, and then everyone, got elected, and you had all these emperors of different, prefects, and they all wanted their own Colosseum. And so they started clipping coins. Like literally, they would cut the edges off the coins because they were made of silver, and they'd steal some of the money. That's why quarters have ridges on them now, so you can tell if they're clipped. Well, when they got caught clipping, they said, you know what, we'll just melt the coins down. We'll put in some bronze, and we'll make more coins. And so they started paying the soldiers, and some of the soldiers said, whoa, 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 whoa. These coins aren't worth as much. So the soldiers started demanding more wages. So prices started to spiral. And then at some point, the coins were worthless because there was no silver left. And the soldiers stopped working, and the Huns came in and took over Rome. So then you fast forward to the British Empire, right? They invaded Mesopotamia in 1913. They incurred a bunch of debt. The pound sterling collapsed. We ascended. We became the superpower. 31 years later, we signed, Bretton Woods, and the dollar became the world reserve currency. And now we have ascended. And to your point, now we are incurring $1 trillion of debt every 30 something, 30, is it 30 days or 30 months? It's crazy.
I thought it was every 3 months or so, but yeah.
3 months, every 3 months. Yeah, 3 months,
Yeah.
every 3 months. So 90 days, 94 days.
Right.
So $1 trillion. And $1 trillion, right? You and I would have to stay here talking to each other for 31,710 years. And as pleasant as that would be, it'd be unpleasant for the listeners.
Sure.
Right? And spend $1 a second for 31,710 years. That's 1 trillion.
Right.
So that $1 trillion is being spent with money we don't have. And so the value of that currency keeps declining. And so the question is the end game. Well, the end game works like this. If you look at history, countries eventually get to the point where they declare a jubilee. So in the 1860s, the UK did this. This was kind of pre-dual entry accounting and computer. So they had these things called tally sticks. So I would lend you money, and we'd break a stick, and we'd each notch, and you'd carry around these big wooden sticks. And if you had a big bunch of tally sticks, you were a big financier. And the government said, all right, we can't pay back the debts to all these people we owe money. So you know what? We're going to collect all the tally sticks, and we're going to burn them and start over. They literally caught Parliament on fire. It burned down because they put them in the furnace, and they started over. And Japan is inching in that direction. Japan today, and you've seen the yen in the news lately, where the yen is super weak. Well, it's because they have 260% debt to GDP. So it's unfinanceable. Nobody wants to buy Japanese debt. And so what do? They just buy it themselves. So the central bank issues yen to buy their own debt. Well, if they keep issuing yen, then the value of the yen declines. And so they have to keep intervening. So they print more money to buy more bonds. And so at some point, they get to the point where they own them all. And they just cancel them. And they start over. And so eventually we'll get to the same place. But when you do that, you don't get to start at the top.
Right.
You actually end up at a lower place. And the people who you owe all the money to have the power. So at the end of the day, the people who own the debt, the Chinese, Japanese, et cetera, who own U.S. debt, I think will be in a better, stronger position. Again, topic for another day. But
sure.
Ultimately, the way we as individuals, as the church, can protect ourselves is to take a portion, I'm not saying all, but take a portion of our wealth and opt out of the fiat currency system. So from 1776 to 1913, a dollar is worth a dollar. From 1913 to 1933, we ran on the gold standard. And then they outlawed ownership of gold. Well, why did they do that? Well, because if a citizen owned gold, then he or she was as strong as the government. They didn't like that. So they outlawed gold. And it wasn't until they went off the gold standard in 1971 that then in 1975, they made gold legal again. They're like, you can own gold as like a trinket, but we don't have to tether the currency to gold. And here's the crazy thing. Back to the mission of the church, right? From 1913 to 1971, income inequality and wealth gap actually went down. Since 1971, income inequality and the wealth gap has been skyrocketing. And so the poor are getting poorer and the needy are getting more needy, and the need for the church is even more robust because the top of the food chain, okay, the people who control the fiat, and fiat means, out of thin air by decree, can devalue the thing that most of us need to live on. And so if we take a portion of that wealth and opt out, put it in gold or Bitcoin or anything else, collectible Porsches, and anything else that will appreciate because it's scarce, that will help us protect. Now, I'm still going to live here. I'm still going to, pay my rent in dollars. I'm going to pay my taxes in dollars, but I'm going to have an increasing portion of my wealth in these assets that will appreciate as the currency continues to devalue.
Makes sense. Makes perfect sense. Well, Mark, we're coming up on our time. I really do appreciate this. Has been just a tremendous explanation. And if folks want to get in touch with you, how can they reach you?
So I'm easy to find. I'm all over the internet. I'm all over Twitter too much.
Sure.
I stink at email. I'm pretty good at direct message. So if you go to @MarkYusko, MarkYusko, and DM me on Twitter, I usually answer. We have a website, morgancreekcap.com. We have two YouTube channels, one called Around the World with Yusko, where we post content, and then another one called Digital Currents, where we have a weekly show where we review what's going on in the ABCDs of the digital age: AI, blockchain, chips, and data.
Great.
And other than that, really enjoyed the conversation. Appreciate the chance to catch up, and look forward to doing it again sometime.
Absolutely. Thank you, Mark. And we'll put links to all that in the show notes of this episode.
Awesome.
Mark, thanks again for sharing your expertise. Thank you all for joining us, and have a great day. God bless.
Thanks, Jim.
Well, that's our show this week. I want to thank you, our listeners, for joining me on today's show. I hope you found this conversation valuable and that it has in some way inspired you to take action to advance the mission of our church. And if this is your first time listening to Advancing Our Church, I hope you're going to stick around and subscribe. You can find us on all places where you download your favorite podcasts. You can find us on YouTube. You can follow us on Twitter, Facebook, Instagram, and LinkedIn. And for more information about our show, please visit us at advancingourchurch.com. Well, that's it for me, everybody. I hope you're having a terrific week. We'll see you next time. Take care, and God bless.